Okay, Sean Bogle here. It's 27 July 2014. In this video, I'm going to go basically elaborate a little bit more on a video I did 2 weeks ago on a strategic review of, like I did on the S&P 500. I went over some targets for this bull market and went over a little bit of volume analysis. But in this one, I'm going to go a little more detail into other sectors. I'll do a brief overview again of the S&P, just some areas, some things that maybe didn't cover, because I'm going to sort of go from strategic to tactical in each index I go over. So we'll start strategic, and we'll end up with a little short-term tactical review in each index. I'll go over the Nasdaq. I will go over small cap, the Russell 2000. That's something, if you're watching been watching financial media, you get a lot of pundits coming out, poo-pooing the Russell 2000, and this is why we're at a top, and this is a bubble, and the Russell 2000 is weak, and yada yada yada. So we'll try to strip the emotion away and just go over a technical review of the Russell 2000. Then I will. That being said, I'll also go over some economically sensitive indices. Like no better than the Dow Jones Transport Index, and I'll also go caveat a little bit on steel index. Brushed on that a little bit last week, and we'll finish up with some emerging market indices like Brazil and Malaysia. So and sort of give you a little bit more of a broader review on the current situation, both strategic and tactical. So let's, without further ado, we'll go with the S&P 500 here. If you watched our previous video of a couple weeks ago, we went over some targets, went over some volume analysis. Obviously, strategically, we're in a pretty strong bull market. We're getting close to some targets here. Fibonacci targets, geometric targets are up in here as well. Again, I'm not telling you that's where we're going for sure. It's just something when when a trade establishes itself like it did, with the S&P 500, especially when we broke out to these new highs last year in 2013. And there's no levels, no resistance levels that I can look at, from the past to say that's, next resistance level and this, that, and the other. What I do is I'll do a target analysis using Fibonacci ratios, and also you could basically just take real simple geometric targets on some sort of pattern and just come up with a target that way as well. But then at least that frames some sort of potential resistance areas where in the past there are none. But and again, on the Fibonacci targets, they are quite powerful. I've seen in my trading, so that's why I do it. And that's all. It's not like, hey, I'm definitely going to this level, because just as surely when a breakout in this case establishes itself, I mean, it could be a false breakout too. So, but in this case, especially the run we've had, obviously that's not the case. That it's a false breakout. A typical false breakout would be prior to 2009 crisis, 2008, 2009 crisis, back in October 2007. If you remember, the S&P basically made a new high by a few points from the high of the internet bubble era, and then basically failed from there. So and the rest is history. Classic failed sort of breakout, right? I don't even think it closed above the level, and that's one of those things you keep an eye at, that I keep an eye out for, because sure, just like we had a great breakout here, there's plenty of false breakouts that can happen, but the key is to watch how the market reacts to new levels, and in this case, we've had a great bull market. We continue to have it. Let's break down here real quickly. Weekly continues to be strong as well. Now let's take a look at some potentially contraindicators. I'm not a market cheerleader one way or the other. So I like to look at all different types of potential information, if you will, that can tell me, where the risk rewards lie going forward. So what I have here is a trend DMI, which is basically just a strength of trend indicator. The blue is an uptrend. The red shows the strength of the downtrend. As you could tell, the blue has been the predominant color because we've been in a predominantly bull market and an predominantly uptrend, right? But we do see some divergencies. The strength of the trend has declined. We have higher highs, but we don't have higher highs in the uptrend. So the trend is sort of weakening a little bit. Not much, but just something to keep an eye. Divergences, for a technical analyst, is something that we like to look at for the momentum starting to leave the market, where it may get a little more risky to be involved on the long side. But again, I'm not here to be a cheerleader for that this is the top of the market, because surely we continue to grind higher. Another thing to look at, again, I went over that 2 weeks ago on the volume side. Relatively recently, basically this whole year, the volume has continued to slack off, which again, you can look at it. I went over it briefly 2 weeks ago regarding company have bought back a lot of shares, and there's less supply out there, so that makes sense for less volume, yada yada yada. There's some other reasonings, but if to me it shows a lack of selling. Cash has become less and less of an asset due to the 0% interest rate. And when we do have a risk-off type of environment, like the last time we had was in this late 2011 area, where hey, it's great to be in cash, but it takes a little bit of time for people to realize, well, I'm not making any money off of my cash. In fact, I'm losing it versus inflation. And they put that money right back into work into risky assets. So no question, there's a bit of complacency in this uptrend due to the fact that we haven't had any real tests, if you will, to the downside. If I'm long and strong, why do I want to sell? The market just continues to go higher, and that's been the case. So I'm just, but at the same point, I like to look at risk reward. This is not a place I want to get, overly bullish and start initiating positions up in here at this case, necessarily, due to the fact that we've had a pretty substantial move. Most people are into buying dips, not buying breakouts. So something else to keep in mind. So with that said, here we go into the daily. This is the sort of the ultra tactical, if you will. Again, we just continue to just whipsaw, but it's sort of the 1.5 foot forward, 1 foot back type of market we're in right now. And again, this shows the dwindling uptrend, strength of the uptrends. Like I said, that's almost the first little warning sign, but I'm not going to I'm not here ringing alarm bells, because I also look at support and resistance, and we haven't really broken any support levels yet of any substantial nature. And the Nasdaq, if we sort of break the July 17th low, that may be, hey, we're breaking this uptrend. That may be another warning sign. Then say, hey, you know what? There may be a little bit more case for at least a move to, say, the 50-day, which is down here, and then we sort of play it as the market plays itself, and we can look at how the risk and reward play out in that case. So let me go into the Nasdaq. So this is where the strength has been. In this bull market. As you can tell, it's already hit a bunch of their targets here that I had written out. And same situation as the S&P, dwindling volume. The trend is not as strong as it was, but it's still well established. on a ultra tactical sense here. We kind of took out these mid-July highs, bumped up against the early July high, and that was your resistance. So what I want to see here going into next week is, really into the ultra tactical short-term time frame, is the market to sort of consolidate here if I'm a bull, and then maybe make another shot at this resistance level. But I really want to see these. Or in that case, it may get shot right back down in here and go sideways, and we'll just play it as that happens. The key support level here is the July low in the Nasdaq, just like in the S&P. So if we break down below that, that may be that first warning sign that we're in for a little bit more lower prices. But right now, it is what it is. We'll just keep an eye on those things. Let's go to the Russell 2000, which is something that people have been, the bears again have been looking. Hey, this is where the weakness is, and sure enough, in July, it's where the weakness has been. So, but again, the market is all about asset rotation, and it could, that could be the classic explanation here as well. That people are selling small cap, they're going into maybe some larger cap, some whatever. There's a flow of funds from one equity group to another, totally healthy, to see that, and that's the market in a nutshell anyway. So, but again, support and resistance on a tactical sense. Same thing as the S&P and the Nasdaq. We're looking at the July lows, and even really on a real short-term basis, Thursday's high. If we can get back above Thursday's high, that breaks that short-term downtrend, and then maybe they can recover. And then I've kind of going backwards here. I'm going from tactical to strategic, but that's where I left off with the S&P and Nasdaq. So it just sort of makes sense to me to do that in this case, because. Strategically, the Russell's been the powerhouse. You look at the monthly, that's a pretty impressive run here that it had, especially in 2000, late 2000, started in base December 2012, and it just, 2013 was where the power was in the Russell 2000. So it kind of makes sense after a really strong 2013 being really the leadership role last year, that it's taken some time off here to digest those moves, right? So, and on a strategic level, nothing stands out as a real warning sign. Now, obviously, if we break below these levels and really break below these the May low, which kind of corresponds to the February low. All right, you know what? We may have a little bit lower to go, but at this point, we're within this broad-based range here. We're clearly in the upper quadrant of this move. Nothing for me to become totally worried about if I'm a long-term investor in some of these smaller cap names. So again, I'm trying to make this as objective as possible and not put any emotion into what's going on. What you hear on the news and people having their agendas to what's going on. On this, I'm basically gonna. These are the three indices in the U.S. right now that have been getting the most attention, if you will. Your big broad-based market, the S&P 500, your tech-heavy Nasdaq, and your small-cap Russell. And I'm just going to briefly go off on a tangent here. I get this Seeking Alpha. They obviously want pretty big financial media internet outlet, and I get a daily. Here's your must-reads for Sunday, and it give you 10 must-reads. And the funny thing is, 3 out of the 10 are really bearish case type of theses. Here's one guy say the day I sold everything, and he sold everything on supposedly Friday, and his reasoning why we're going lower. And then here, the implosion is near, signs of the bubble's last days, and then and then on 10, why this is the most hated bull market of all time, and he's basically telling you why the financial engineering and it's not, what they're doing is not going to work, and we're going to go to another depression and whatever. So there's a lot of doom and gloom, and I look at it as a contraindicator, not to say they're going to be wrong, but just on a completely objective basis. Usually a bubble is when people on the media are saying exactly the opposite, that this is a new paradigm and we're in a new, this is a new, whatever you want to call it, new market environment, and just like they did in the real estate bubble. You saw them come out. They were out there. No one was calling. Very few were calling the top in real estate, and then obviously the media was really harping on the people who were pounding the bullish case. So anyway, that's my tangent of the day on that. So again. They may be proven right. I'm not going to sit here. I'm the smart guy who knows everything, but I just, looking at sentiment, I like to look at some sentiment indicators, and I look at them as a contraindicator. So here's one of them that shows, when people get bullish, the financial bloggers are very bullish, right here in September 2012 or October 2012, and the not that many guys are bearish. That was your classic top in the market, So these extremes are pretty good predictors in tops and bottoms, at least short term in a tactical sense. So that tells you about sentiment is the greatest contraindicator in the world. That being said, right now we're kind of real neutral. So on a risk reward basis, if I'm looking to, so I don't, it's telling me we're not in the top, we're not in the bottom, we're just exactly what we're in. It's sideways, kind of like a grinding type of market, So so I don't see nothing screaming really a buy, and nothing screaming sell at this point. It's just sort of, we're in this sideways type of market, but of course the financial media, they need to talk about something, so they'll, what gets the most people to watch them is, getting people to talk about extremes, right? So unfortunately that's the media we're in now, right? So anyway, so enough about that. Sorry about that. I went off on a tangent there, but let me get back into where I was at, where I was going to go over the Dow Jones transport. Let's look at some economically sensitive, right? Because the stock market's supposed to be a predictive indicator of the economy, and the stock market leads the economic situation. So if we look at the Dow Jones transport, boom, look at that. That's even more impressive than the small cap Russell 2000. To be honest, especially for something, and again, they haven't had any sideways movement. They took off in late 2012 and haven't stopped. So obviously, I don't know if you want to call it the smart money, but the people who are able to move markets are heavily invested in economically sensitive transport. Even when we break down the tactical level, solid uptrend, and that's a big part of where the money's been and continues to be. So, does that tell me that we continue? Again, I don't know, but the money's still there, and very impressive. So, obviously, the guys that move markets, the big fund managers, they're but betting on the economy to continue to be strong. I touched on steel last week. I'll go on that again, being that to me this is like the ultra economically sensitive index, because this is where people are willing to start building again and doing this, that, and the other. Obviously, they're going to need steel for it. And technically speaking, it's been pretty weak. It's been probably one of the weaker indices in the market. I mean, here's the 2008, 2009 low, and we are, we're not like all the other markets, well above any of these highs from from the crisis. We're still stuck down in here. I do see a little on this is the monthly, a bit of an inverse head and shoulders pattern that if we break, to me, if we break above this line in here, could that could be the spark that maybe allows us to trade higher. I mean, we really see it on the weekly. Break these highs. That means to me, money's flowing into this sector. Hasn't happened yet. What I really need to see is a break above this level, and it's sort of and then that becoming support, right? Once we break resistance, the resistance becomes support, and then we should be making that stair step higher. But it's something I'm going to keep an eye on, and I've talked about emerging markets, Brazil in particular, and where money seems to be flowing back into those sectors. And this could be one of those things where that thesis where if money's flowing to emerging markets, what are emerging markets? They usually have, they're gonna a lot of that money is going to end up going into infrastructure and stuff like that. Well, guess what? We need steel to build infrastructure, and that may flow into this, steel index getting stronger. Again, we've gone over Brazil. This sort of this descending sort of triangle pattern, if you will, is usually a bullish sign if it breaks above, which we sort of peaking above. Haven't really established that it's a viable breakout yet. I really would like to see it trade up into this mid 50 range, and that would tell me, hey, that's a pretty good break of this upper range of this descending triangle. So we'll see. In a bit of Brazil, but what actually, what I like about this too is you definitely, volume. We've got some really good volume here on these lows. Got some good volume in these lows. Potentially, hey, the weak hands have folded. The strong hands have now own some of this or invested in Brazil. So that's a potential for it to now get a sustained move higher. We'll see. I mean, it's definitely established now. A bit of in the medium term, that uptrend in the DMI. We'll see if that continues. It's actually potentially going to peak up higher here. We'll see how that plays out. As you know, I'm a big relative strength advocate, and in the emerging frontier or emerging market, frontier market, I'm looking at Malaysia here. So where Brazil, I mean, if we look at the monthly here, where Brazil is down in here, here's the financial crisis. Look at Malaysia. I mean, it's at 10-year highs or close to it, and that's pretty impressive. So Malaysia definitely is relatively stronger than Brazil, and if emerging markets become a play for the next year or so, this is actually someplace I'd like to put a little bit more, money into on a risk-reward basis, just for the fact that it has been so strong. And if you look at the weekly here, and again on a technical basis, you have the highs of June and the highs of October of last year. We break above those at that level. This resistance should become support, and then we should be, or potentially off to the races here, at least to challenge these highs and maybe go higher. Again, I'm not a fundamental analysis. I can't tell you too much about Malaysia. I'll have to talk to my Malaysian contacts to get their take on that. But on a technical basis, purely on emotional basis, this has been looking pretty good. Now again, this could turn around and just go lower and then say, oh, okay, it was a double top, right? So I'm not here to tell you what the predictive nature of this is, but if I see a prior level resistance get taken out, that usually means, obviously money's coming in there into that sector, and if it's a strong strong hands, it could be a game changer, and really put this market much higher and create a bit of a boom for the Malaysia in general, if you will. So Anyway, it's something I'm going to keep an eye out for, and I think on a risk-reward basis, these are the trades we like to look at because, hey, we've got some pretty good consolidation. You break out here, you know what? If this market then comes back in here, breaks below these moving averages, boom, I'm out of it, gone, done. It was a false breakout. But if this thing just starts up and continues to stair-step higher, you're in at a good level. Your risk was here, and who knows what your reward is? You know, you're looking for, you know, at least a 2, 3, 4 to 1, if not more, type of move versus your risk. So that, you know, and that's a game. That's the game in a nutshell, the way I see it. So anyway, that's all I really have. Thank you for your time. Sorry for the length of this, but I figured I'd go a little bit more into detail and cover a broader range of sectors. Cover some international markets, like I said. As you know, on the same thing, India's been doing quite well. I'm not a big fan of the whole BRIC. I mean, you have this BIC ETF, which is the BRIC, and it's doing real well. But the problem here is, with the crisis in Russia, do I necessarily want to be invested in Russia when Putin's going off the deep end and acting like a mix of Stalin and Hitler? I mean, and I'm not. I don't mean to point him in the category of a mass murderer yet, but obviously his reign is a cult of personality, and there's always a potential for a guy like that to just sort of believe he's some sort of demagogue or whatever, and I don't know. I haven't seen the soul of this guy like George Bush did, but it's investors hate that type of risk. I like to see. We want stability. We want stuff like that. So I'd much rather be buying individual country ETFs than buying a sector like the BRIC, which again which did real well, in the last 10 years up to the financial crisis. But where's the money going to be in the next 10 years? Like I said, why do I want to buy a BRIC ETF that excludes a country like Malaysia, which we've just shown to be relatively stronger than a lot of these other countries like Brazil and Russia and whatnot. So anyway, sorry, I just went a little bit longer than I intended to. So again, thank you for your time, and have a great week.